Welcome to today's presentation and strategic proposal for Boulder Brands Incorporated with Brands-Esplin and Perez. Boulder Brands is one of the largest natural consumer packaged food companies in the United States, with annual revenues of more than $460 million. Boulder Brands' goal is to be the most innovative and trusted health and wellness company in the world, and their vision is to change the way the world eats, one product and one solution at a time. Boulder remains focused on building brands targeted at highly motivated consumer health needs, while focusing on growth through new channels, products, and acquisitions. As we continue through our presentation, you will find that our current situation is defined by the rising demand for gluten-free and organic products within a highly competitive market. Boulder's position in the market is struggling to maintain margins and growth. Key metrics identified for success indicate Boulder's management and leadership must come together with a vision for the future that reinvigorates shareholder value and trust in the company. The next several slides will highlight the general environments Boulder operates within. The economic environment is promising. The United States has the third largest population of all countries in the world, and the United States has now enjoyed more than 3 years of uninterrupted economic growth and falling unemployment since the 2008 recession ended. Sales of organic products in the United States jumped to $35.1 billion in 2013, up 11.5% from the previous year's $31.5 billion, and it is the fastest growth rate in 5 years. Consumers are making the correlation between what they are eating and their health. That knowledge is in turn spurring heightened consumer interest in organic products. These trends will continue to affect which types of consumer packaged products are developed to meet the growing demands. The sociocultural environment for Boulder is a formidable driver for where the grocery industry is headed. The brands that are focused on health and wellness are directly affected by cultural shifts and the choices of their consumers, particularly in the grocery industry. Consumers in the United States are voting with their wallets as more people are asking for organic, non-GMO, all-natural, and now gluten or grain-free diets. The demand has driven organic food sales from $11 billion in 2004 to approximately $27 billion by 2012. This emerging trend is expected to continue to grow and outpace conventional food and beverages. While the global environment is largely irrelevant for the organic food industry in the United States, we can recognize the shift to natural and organic foods is a rising trend in America. In this respect, America is catching up to the fresh and natural eating habits found in other countries, such as France and Italy. Technology has had an interesting impact on the natural and organic industry. Organic food producers focus on improving the health of the product by as little technological intervention as possible. As a comparison, the conventional market of mass food production considers genetically modified foods advancement, while the natural food industry deems breakthrough tortilla replacements made from only 100% coconut the miraculous technology. In addition, the medical industry and subsequent emerging technology is driving new knowledge around digestive diseases. The U.S. Department of Health and Human Services estimates that 60 to 70 million people are affected by digestive diseases, and the gastrointestinal health supplement category brought in nearly $1.4 billion in consumer sales in 2011, and that was a growth of 14% from the year before. Healthy eating has become a hot topic in the political arena, with more and more organizations lobbying to the different branches of the U.S. government to improve ingredient labeling claims. Consumers are more aware now than ever of their own nutritional deficits and what poor eating habits can do in terms of their long-term health. As a result, today's consumers are seeking out healthy food with greater urgency. Skeptical or confused consumers aren't likely to pay a premium for healthier food, making it hard for manufacturers to justify investment in nutritional ingredient upgrades. Under a law signed in June 2014, Vermont will soon require that food companies tell consumers which products on grocers' shelves have genetically modified ingredients. This law puts Vermont at the forefront of a national movement that major food processors and agricultural companies are doing their utmost to kill. This opens the door for other states to follow suit as well. Let's talk about demographics a bit. The natural and organic consumer has been broken down into 7 different segments you see here. 2 of those segments, true believers and enlightened environmentalists, currently account for 46% of organic purchases. It is interesting to note that there is not one specific age structure, geographic area, ethnic mix, nor income level that coincides with purchasing organic products. It's also interesting to note that baby boomers, Generation X, and the millennials represent nearly 60% of the U.S. population between the ages of 20 and 65. The organic and natural foods industry offers sustainable products as their core business, providing environmental, social, and economic benefits for public health. More than 83% of Americans consider sustainability when buying food and would like to see more options available that protect the environment. Consumers look to companies to help them understand the broader implications of their food purchasing decisions. Buyers have somewhat limited options when it relates to gluten-free or organic type products. However, as additional organic and gluten-free options are introduced to the market, the bargaining power of buyers will increase because there is little to no cost to switch products. Only 11% of households reported buying gluten-free products. Organic sales account for over 4% of total U.S. food sales and are now sold in over 20,000 natural grocery stores and 3 out of 4 conventional grocery stores. With the large number of stores offering organic and gluten-free products to small but growing percentage of the population, the buyer has added bargaining power. The buyer is willing to pay a higher price for organic or gluten-free type products because they expect it to be a better quality than similar conventional type substitute products. This allows the supplier to pass on the higher cost to the buyers, which reduces their bargaining power to the extent the prices are reasonable. Supplier groups for the consumer packaged goods industry, specifically those targeting the gluten-free and organic segments, have bargaining power due to their dependency on organic and gluten-free type items. With the demand of organic products growing over recent years, the suppliers will have increased bargaining power to fuel the added growth. About 81% of American families reported to be purchasing organic food at least some of the time. In addition, domestic organic food production has increased about 240% between 2002 and 2011, compared to 3% in the non-organic food market. This shows the dependency on growing segment, giving the supplier bargaining power until supply catches up and exceeds demand. The threat of new entrants into the market is high. The gluten-free products market is projected to reach 6,893 million by 2019. In food service, gluten-free cuisine ranked 5th among the top 20 trends, and gluten-free and organic were once thought of as a tasteless or poor quality, albeit they were perceived to be a healthier choice. Now manufacturers are focusing on better taste and quality to continue to appeal to the growing segment. The increasing number of people aware and interested in the gluten-free and organic market, combined with better tasting and higher quality products, will continue to compel the growth of this segment. The threat of substitute products is very high and will continue to be substantial for the gluten-free and organic segment of consumer products. There is an abundant offering of alternatives to gluten-filled and heavily processed foods. The food industry is responding to this growing consumer base with new choices and formulas to meet existing taste profiles. Companies are scrambling to redesign their breads and cereals to have the same taste and feel of a gluten-filled product. Even though the population with celiac disease is less than 0.1%, reports indicate almost a fifth of the population are now buying gluten-free. New product launches featuring gluten-free claims rose from 600 in 2007 to more than 1,600 in 2011. With the rapid advancement of social media and internet advertising, the food industry is no longer competing on just the grocery shelves at the market down the street. With the rise in celebrity endorsements of eating habits like paleo or whole food no grains eating, the younger generations are now asking their parents for gluten-free. General Mills now has over 400 gluten-free products, and Dunkin' Donuts is rolling out a gluten-free offering at a premium price, of course. Getting into the gluten-free market is relatively easy, with consumers still building brand loyalties, as new entrants and new product alternatives drive aggressive marketing campaigns. 3 of Boulder Brand's leading competitors are Annie's Incorporated, ConAgra Foods, and Hain Celestial. Let's take a quick look at the performance of Boulder against these 3. Boulder has experienced an aggressive growth pattern over the past 3 years, with a small decline from 2012 to 2013. This dip was common in the industry, with many of its competitors experiencing the same decline in sales. All companies, with the exception of Hain, have seen an improvement in all their liquidity ratios. This shows that the companies are in a better short-term position to stay ahead of debt and pay their bills. Boulder has the lowest operating cash flow ratio, which is a little concerning as they are on such an aggressive growth pattern and will need cash to pay their increasing cost of goods sold. The comparison of the quick and current ratio shows that Annie's is the best position of the four companies, with the highest ratios over the 3-year period. ConAgra does have a higher spread between the current and quick ratio, indicating they have a higher amounts of inventories with slower turnovers. All four companies appear to be improving their overall liquidity, as evidenced by both ratios, which is a positive trend if they can maintain in the future with continued improvement of inventory turns. Boulder and ConAgra are the laggards in profitability, with much lower profit margin, return on equity, and slightly lower operating margins than Hain and Annie's. Boulder has the highest gross margin and the worst 3-year average for profit margin, which is very concerning for overall efficiency as a company. Boulder has significantly higher fixed costs and overhead that are taking away overall profitability, and will need to find a way to lean down fixed and overhead costs, increase sales volumes, or raise unit prices to compensate for the higher costs and stay competitive moving forward. Boulder's return on equity would be very concerning for banks and investors also, because of their inability to provide much of a return on each dollar they are given. Boulder has the lowest average and would be the most concerning, where it hasn't shown any real improvement over this 3-year time span. As shown in the ratios on the previous slide, the earnings per share for Boulder is also the lowest of the four companies, which represents a challenge to secure new shareholders. Boulder must show they can turn their operating efficiencies around, promoting future growth through a discounted stock price that is cheap to invest in now with promising returns for the future. As the competitive ratio analysis showed, businesses within the food industry, and particularly the natural and organic food segments, can be measured against 3 key success factors: profitability, management efficiencies, and future funding. For profitability, it's beyond the basic need for profit to keep a company alive. The profitability of a business is a critical measurement in understanding what goals need to be achieved on a go-forward basis. Key metrics include gross margin, profit margin, and return on equity as key indicators on whether you are or you will become successful in the natural and organic food industry. Internal management efficiencies drive the continuous improvement required to stay competitive for the long term in the natural and organic food industry. Inventory turnover, asset turnover, and operating margin are critical checkpoints for understanding how accurately you are achieving your forecasts and goals measured against your future business. The natural and organic markets have been the fastest growing segments in grocery for a few years now. Projections continue to show strong growth. Future funding is critical in staying relevant in this rapidly expanding market by providing the capital needed to invest in new product lines, tastier and healthier recipes, and further brand acquisitions. There are 5 critical metrics: earnings per share, debt to equity, current ratio, quick ratio, and operating cash flow. These are used when evaluating the viability of a leader in the natural and organic foods business to secure future funding for sustainable growth. Here you will see the comparable ratios broken into the 3 key success factors for each company. Let's take a moment to understand Boulder's competition and how they rank in key success factor performance. We will also touch upon their strategic positioning in the market and their goals for future growth. Annie's has the strongest profitability rating and the best overall performance when looking at a 3-year average of all the ratios, with the exception of inventory turns, which is second to Boulder Brands. Annie's has the highest current ratio, quick ratio, and operating cash flow, indicating they are a safe company to lend money to. Annie's employs a focused differentiation strategy that sees their target market as one that does not care about price. They consider their customer to be better educated and more health conscious than the average consumer, and they believe they can build brand loyalty and attract new customers by remaining authentic and operating in an honest, socially responsible, and environmentally sustainable manner. Annie's goals are to pursue top-line growth through expanded distribution and improved placement, expanded household penetration and consumer base, and through continuous innovation and brand extensions, while remaining authentic and staying true to their core values. Annie's will also be investing back into infrastructure, expecting to hire new employees and implement an ERP system. The worst profit margin, second worst profit margin to Boulder, and a return on equity ratio that is trending down all spell trouble for ConAgra. Their downward trending return on equity ratio indicates they need more capital to generate more profit. The 3-year average return on equity is currently the highest, but if they don't turn things around, they will continue to have profitability issues moving forward. ConAgra is clearly a middle-of-the-pack company when it comes to management efficiencies, with the second worst inventory turnover ratio, lowest operating margin, and second highest asset turnover ratio. Conagra has a healthy earnings per share at 1.22, ranking second in the group. However, it fell significantly from 2012 to 2013. They also have the highest debt to equity and lowest quick ratio, indicating they are not the ideal borrower either. The current ratio is second worst, but their quick ratio being drastically lower than competitors implies they are inventory heavy. Conagra employs a cost leader strategy that is focused on having the most efficient process and streamlined cost. With an established portfolio that is value-focused and competitive, Conagra will be working to create a more successful, customer-centric, effective, and efficient company. Conagra strives to grow their branded and private branded portfolios through innovation, improving their trade spending effectiveness, enterprise business planning and pricing analytics, and implementing cost-reducing initiatives throughout all areas of their business. With their gross margin being the second worst, you worry about how competitive Hain will be able to be on price. They are either paying more for their direct goods, resulting in a higher cost of goods sold, or they are not able to charge as much for their product as competitors. Hain does have the second highest profit margin and return on equity. This shows they may not have as much overhead expenses as some of their competitors, which will help profitability moving forward. Hain has the lowest inventory turnover rate, indicating they are not moving through their inventory as fast as their competitors. With the second highest operating margin and second worst asset turnover ratio, they are indicating mixed results for their overall management efficiency. Hain's overall health is encouraging for them to receive the necessary funding for future growth. They have the highest earnings per share of all the listed companies and rank second in current ratio and quick ratio. Both banks and investors will be willing to invest in their operations for the foreseeable future. Hain employs a differentiation business strategy to be the leading marketer, manufacturer, and seller of organic and natural products. Their main business strategy within each operating segment is to integrate brands under one management team and employ uniform marketing, sales, and distribution programs. Hain seeks to capitalize on the equity of their brands and the distribution achieved through each of the acquired businesses with strategic introductions of new products that complement existing lines to enhance revenues and margins. Hain seeks future growth through internal expansion as well as the acquisition of further complementary brands. Now that we have a general understanding of Boulder's competition and position in the market, let's dive into Boulder Brands' internal analysis. Boulder has the highest gross margin percentage but lowest profit margin. They have clear advantages when it comes to direct costs, which could be through supplier relationships or higher selling prices. However, they have the most overhead expenses of the group, which will hurt their overall ability to compete long-term in acquiring additional market share. They also have the lowest return on equity, signaling they will need more capital to continue to make a profit. Boulder holds the best 3-year average inventory turn ratio, but it has been declining each year. And Boulder has the lowest asset turnover ratio and second lowest operating margin. This inefficiency is apparent in their low profit margin. It will be a challenge for Boulder Brands to continue to receive additional funding for their growth, with their earnings per share being the lowest at 0.11, the second worst debt to equity ratio, which has been rising each of the last 3 years, and the lowest current ratio and operating cash flow all raise red flags to banks and potential shareholders. Boulder utilizes a focused differentiation business strategy, striving to become the recognized leader in providing nutritious and good-tasting foods made with pure and simple ingredients that target specific health trends. Using a broad platform to introduce new products and create further innovation, Boulder Brands will expand into new channels of distribution to gain increased market share. Future goals for Boulder Brands include product innovation, introducing new products and expanding distribution in the natural segment, acquiring new brands and new technologies, expanding into new channels of distribution, in particular food service, expanding the business geographically in regions outside of the United States, investing in the infrastructure and human resources business grows, focusing on improvements in profit margins, licensing brands in the Smart Balance segment such as milk, popcorn, and other product areas, and maintaining profitability in the Smart Balance segment. The management team at Boulder Brands brings together a group of seasoned food industry veterans with over 100 years combined experience. Some of that experience includes prior appointments with leading brand name products, as well as previously working for some of their top competitors today. The last few years have seen significant turnover at the executive level, however. With Boulder focusing on improving shareholder value and trust, they will not be able to afford another wave of departures and will need to work to mitigate that risk. One of the key resources that Boulder Brands possess would be the experience of their management team, as mentioned on the previous slide. Another key resource the company has would be their timing to market. Boulder was one of the first companies to focus almost exclusively on trending diets such as gluten-free, with Hughes leaving his other company to set up Boulder in 2005. He recognized the trend back then and acted upon it. A very important resource that Boulder has would be $65 million credit line and $16.7 million of cash and cash equivalents. Improving internal operating efficiencies and the struggle to gain back shareholder confidence is Boulder's key problem. Boulder Brands is a young company with a long journey ahead. The last few years have seen Boulder invest heavily into acquisitions and restructuring, including numerous name changes, location moves, and product reintroductions into the market. Boulder has also seen a near-complete turnover of the executive leadership in the last 2 years. This myriad of change is reflected directly in the dropping stock price of Boulder since July of 2013. Confident shareholders will be critical for success and investment as Boulder requires more capital to continue their upward trend in sales growth, as noted in 2014 quarterly reporting. The top 3 recommendations for Boulder are very closely related. 1. Boulder must increase profit margin by increasing their total sales. They have a high percent of fixed costs and overhead relative to their total sales, so the additional revenue will help cover their fixed costs and drop to the bottom line profit. Boulder's been investing a lot into marketing their products to help expand their position in the market and create brand loyalty. Assuming their marketing campaigns are structured to be the most effective use of their marketing dollars, the added exposure will increase total sales and therefore effectively increase profit margins. 2. Boulder has an opportunity to improve operating efficiencies by consolidating their manufacturing facilities into their new Boulder, Colorado location. They have an expiring lease in Canada that will go away in 2015, and this will help reduce their operating costs tremendously. And 3. To address the recent problem with their high turnover of executive leadership, Boulder should create a stock incentive plan that is proportionate to their time with the company and its overall profitability. With increased sales stemming from their aggressive marketing campaigns to grow brand exposure and loyalty, the executives will have the tools to operate the company efficiently in order to increase their interests. The plan needs to be structured such that they have an incentive to stay long-term and contingent upon them operating efficiently and profitably. The best plan and implementation recommended for Boulder incorporates all 3 recommendations from the previous slide, but truly begins with the need to continue to focus on gaining additional sales to cover their existing level of fixed costs. They have been investing large amounts into marketing and will need to continue to maintain or increase their marketing strategies to promote awareness to their products and therefore gain market share. The increased sales will help cover more of their fixed costs and therefore improve their profit margin. By improving their profit margin, their earnings per share will increase, as will some of their other metrics that are falling short of their competitors. This will help instill confidence in their current management team from lenders as well as investors. To implement this recommendation, Boulder needs to ensure they are constantly evaluating their target market and the up-and-coming trends their market is demanding. They will need to continue to invest in research and development to constantly improve their product quality. If their products are quality enough that separates them from some of their competitors, they will lock in their customers who will continue to purchase and increase loyalty. Increasing sales from existing customers is usually the cheapest way to increase revenue. Additionally, their lease in Canada will be expiring in 2015. They should not renew this lease and consolidate facilities into their U.S.-based location in Boulder, Colorado. This will move them closer to their target market and reduce redundant fixed costs and shipping expenses. This will allow them to consider price reductions to be more competitive in the market or give them the added margin to cover their fixed costs, improving their profit margin. The improved profitability should help incentivize their existing management team to stay with Boulder and not have the higher costs from hiring new management. Once again, this will help reduce the fixed costs and improve profit margin from the reduced turnover. Thank you for your time.